the chairman of Korea Exchange Bank, will give opening remarks. Please welcome Mr. Volcker.
Distinguished guests, ladies and gentlemen, I'm pleased to welcome you here for this morning's distinguished lecture with Chairman P A Volcker. I'd like to express my appreciation also to the Institute for Global Economics and the Korean Investment Corporation for organizing and supporting today's forum. We're really fortunate that Chairman Volcker has accepted our request to travel so far and share his thoughts with us this morning. It's really a great opportunity. As you know, the theme of today's forum is rebalancing the global economy. As you're all aware, the global economy is still wobbling from following the recent financial crisis. And government policymakers and business leaders around the world are struggling with a host of challenges, uncertainties, and decisions that will shape the global economy for many years to come. So it's a time that requires wise, informed, and thoughtful leadership. So it's natural that Chairman Volcker has once again come into the spotlight as one of the leaders who will help meet those challenges. Chairman Volcker's reputation was widely established when he, as chairman of the U.S. Federal Reserve in the 1980s, displayed the courage and conviction to slay the inflationary dragon that was ravaging the U.S. and global economy at that time. But there are many other examples where, because of his principled and strong leadership, he was asked to take on issues that few could or would take on. Whether it was the Holocaust victim settlement, the UN oil for food inquiry, or the Arthur Andersen Enron accounting scandal, in each case, Mr. Volcker brought about resolutions and changes that have shaped our world for the better. So it was no surprise that President Obama called upon him to be the chairman of the President's Economic Recovery Advisory Board in the middle of the recent crisis. And once again, he has largely shaped the long-term direction of the U.S. financial policy and bank reform legislation, including the now famous Volcker Rule. A former U.S. Senator Bill Bradley once described Chairman Volcker as the voice of calm in times of financial crisis. And above all, he has been candid in a world where candor often takes second place to public relations and spin. So today, I think, as we run up to the Seoul G20 summit, it could not be a more fortunate and opportune time for us to hear the insights of Chairman Volcker. I thank you all for coming to learn and exchange your ideas to rebalance the global economy. Thank you.
Chairman Volcker wants to speak as early as possible, but I have to say something in advance. Good morning, ladies and gentlemen. As a co-sponsor of this meaningful event today, I have the honor to introduce our speaker, Mr. P A Volcker. In the course of his career, Mr. Volcker worked in the U.S. federal government for almost 30 years. Just name a few, as Chairman Volcker mentioned in his welcoming remark, from 1979 to 1987. He served 2 terms as chairman of the Board of Governors of the Federal Reserve, first appointed by President Carter and reappointed by President Reagan. He is credited with leading the role in ending a period of high inflation and restoring a base for sustained growth. Before becoming the chairman of the Fed, Mr. Volcker spent 4 years as the president of the Federal Reserve Bank of New York. He was also previously Undersecretary of Treasury for Monetary Affairs from 1969 to 1974. Upon leaving Washington in 1987, he became chairman of the Wolfenson and Company, a company concentrating on the provision of investment banking services to a limited number of large domestic and international organizations. He retired as the chairman and CEO of the Wolfenson when it merged with the Bankers Trust. In November 2008, President-elect Barack Obama appointed Mr. Volcker as the chair of the President's Economic Recovery Advisory Board. Educated at Princeton, Harvard, and the London School of Economics, Mr. Volcker is a recipient of honorary doctorates from each of his alma maters, as well as a number of other American and foreign universities. Ladies and gentlemen, Please join me in welcoming Mr. Volcker.
I thought maybe the young lady was going to offer to deliver my remarks, but I haven't prepped her sufficiently. But let me say what a pleasure it is to be here in Seoul in Korea. I haven't been in Korea for some years. I made a practice of, I was first here in 1966, and for a while I made a practice of coming back no less than every 10 years, but I think I've skipped a few years since then as I have aged. I find it difficult to keep up with what's been going on physically, mentally, and business-like in this country. And I must congratulate you all on the work that you've done, symbolized by your membership in the OECD. You know, we divide up the world these days into the developed world and the emerging world. And I guess in many people's eyes, Korea is part of the emerging world. But I think you're really part of the developed world. But you are doing better, I'm sorry to say, than most of the developed world. So we will welcome you on this side of the Great Divide, if there is a Great Divide. You know, we have, from my perspective, maybe from your perspective, live in kind of an upside-down world. It wasn't so long ago that we had the great Asian financial crisis. Korea was severely affected at that time. The banking system was in trouble. There was a great effort to mobilize assistance quite properly to the Korean banking system. You recovered. Now you're one of the strong points, only less than 15 years later, of the international economy. So things have changed. But you are symptomatic of the prosperity in this part of the world, in Asia, in East Asia in particular, which contains the brightest developments in all the world, while the developed world, as you know, was caught in a difficult period of recession, recovery, but slow recovery, unsatisfactory recovery, and the contrast between the vibrant China, East Asia, Korea, other countries, and the developed world is quite striking. Now, I guess I had suggested the title for my remarks today is Rebalancing the World's Economy some months ago. It happens to be particularly timely. I guess that's what the G20 is supposed to be talking about next week. And for good reason, because the present world economy is unbalanced. It's unbalanced in a way that can't persist if we are going to have a thriving global economy. I think you well understand the general background, the story of the 21st century, which has been characterized in the United States by too much consumption, too little savings, too much borrowing, too little investment. And looking at the contrast here in Asia, led by China, but not China alone, of too little consumption, too much savings, too much reliance on exports, too much investment, and particularly the U.S. dollar. I never thought that I would be talking about other countries holding trillions of American dollars. I used to hear the word trillions in association with the Japanese yen, but not the American dollar. And I think it is not symptomatic of a healthy economy, but an economy that has problems and dangers that need to be corrected. Now, you know what happened. We consuming too much, overspending, all easily financed partly by the inflow of money from Asia and Middle East and elsewhere, very low interest rates, contributing to speculation in our real estate market, not unknown throughout the world, speculation in real estate markets, but particularly dangerous in the United States because it was financed so weakly, financed by subprime mortgages, very little down, very little checking of the basic credit worthiness of the borrowers. This is all unsustainable. And we kind of knew it at the time, and some people talked about this was unsustainable. The United States couldn't borrow 4 or 5% of its GDP year after year from other countries without running into a problem. On the other hand, other economies were out of sync as well. But it was, it suited everybody's convenience for a while. We like to consume in the United States. Countries in Asia like to save. The contrast is all summed up in one figure I like to cite. Consumption in the United States went up 5, 6, 7% of the GDP to about 70% of the GDP in recent years. In China, now the second largest economy, the contrast is consumption in China is 35% of the GDP. And it's easy to say that 70% is too big, but I think it's fair to say over time 35% is too small in terms of a balanced growth in Asia and China and elsewhere. But how do we make this correction? Well, I'll tell you, we have a lot of experience in making corrections in economies over the years, and too seldom does it come down to intelligent, complementary economic policies. Usually it comes down to a financial crisis, when the disequilibrium becomes so great, the extensions of credit become so large, the uncertainties become so apparent that you have a real crisis in financial markets. And we've had a big one, a big crisis in the United States. Not in the United States alone, it's spread, as you well know, throughout the developed world. Now, where do we stand now? I think it's fair to say that that crisis has some therapeutic value. It begins to force changes in the right direction, but it is a very uncomfortable process. American households have learned that they better save a little more, maybe quite a lot more, to protect their own future. American companies, interestingly enough, particularly big international companies, have come through this crisis in a relatively strong position. The financial world, on the other hand, has obviously been disrupted. It's only partly recovered. It remains a danger point, an area that needs, in my opinion, still a lot of work. Now, we put that together, an underlying imbalance in the economy, a major financial crisis, and what it almost inevitably results in is not a robust recovery, but a slow and labored recovery. An ordinary recession in the United States, but elsewhere, but in the United States, where I know it best, you have a recession, inventories go down, then they go up, business investment goes down, then it goes up. Interest rates go down from high levels, and then you have a very rapid recovery. In the mid-'80s, which was our previous deepest recession, a couple of quarters in the recovery, the economy was growing 5% a year, 6% a year, 7, 8% a year, I believe, at an annual rate at one point in the mid-1980s. There is no expectation that that kind of performance will be repeated this time. And there's a lot of evidence over history that when you have the basic underlying economic imbalance and then a big financial crisis on top of it, recovery will be slow. And that's what we have. We have an economy that's growing 2% a year on the last figures. Most projections range between 1.5% 2.5%. That's not enough to bring down the unemployment rate very rapidly. So there's a lot of unhappiness, undoubtedly reflected in substantial part in our election a couple of days ago. But I'm afraid in this situation I can't offer you great hope in the short run of several years, of a much more rapid pace of growth. We know about the actions of the Federal Reserve. I don't comment on monetary policy ordinarily, and I won't depart from the details of monetary policy today. But obviously, the action that was taken in an effort to try to spur the economy a little bit is not the kind of action that's likely to change the general picture that I've described of slow and labored recovery over a period of time. It may be necessary to keep the financial markets functioning at all effectively, but it's not going to change the underlying picture, in my opinion, in a substantial way. A lot of discussion about exchange rates and the international monetary system. And I think this crisis has disclosed a lot of problems in the international monetary system and in the international financial system. People felt relatively comfortable, unfortunately, about international monetary affairs and indeed about financial markets late in the last century and in the early years of this 21st century. Somehow the comforting theory developed that free markets would take care of themselves, that you wouldn't have extremes of speculation. You might have some ups and downs, but that risks will be dispersed in a way that they will not be damaging to the economy as a whole. Well, that kind of comfortable feeling, which pervaded the academic world, I'm afraid it pervaded the regulatory world, and it certainly pervaded operators in financial markets that were making tremendous amounts of money. It was a comforting theory, but I think we've seen demonstrated is that financial markets cannot be relied upon to maintain their stability, an orderly pattern of distributing savings into productive investment without some degree of governmental intervention, control, and regulation. So we are in the process of moving back in that direction, and I hope and trust that we will do it in a reasonable way. You know, the United States, to some degree, I think, is leading that effort with the recent legislation that was passed. I don't love every particular part of that legislation. I would do it somewhat differently, but everybody would do it somewhat differently. But on the whole, I think the basic principles of that legislation are important and useful and will help the evolution of the financial system in a constructive way. And I hope that other countries in Europe and elsewhere will join in a somewhat similar pattern. But a lot remains to be done. To give you a little background from the standpoint of the actions you see taken by the authorities in the United States today, there is a political backlash against government spending. I think that political situation makes it virtually impossible to have further large fiscal stimulus. However desirable that may be, and there's some argument about the substance of that, but I think it's a fairly safe bet that given the political situation in the United States, you will not see another large fiscal stimulus. So that puts more of the burden back on the monetary authorities, as they see it, and helps explain the action that they've taken. But let me point out, too, that while the market for some securities is functioning reasonably well, and particularly for corporate securities, the biggest single part of the capital market in the United States, the world's biggest capital market, is residential mortgages. The residential mortgage market is not functioning in anything like a normal way. 90% of all the mortgages made in the United States today, residential mortgages, are supported by the federal government. The federal government has taken over those two big institutions of Fannie Mae and Freddie Mac. They have a government insurance body, FHA, which minor agency a few years ago. Those three agencies are creating and financing 90% of all the new residential mortgages in the United States. That is not a normal situation for the world's greatest capital market, and it has required continuing support from the monetary authorities, who themselves acted as a financial intermediary to buy mortgages. Very unusual circumstance in our history. So there's a lot to be done, a lot of work to be done by the United States. And I speak about a relatively slow and contained expansion, but it's a time when we have a lot of work to do. If we are going to deal with the potential inflationary consequences of monetary policy down the road, not today, there's not much concern about inflation, not much actual inflation in the American economy today, but understandable concern about the combination of money creation and big budgetary deficits a few years down the road as the economy recovers. So one of the constructive things we must do, in my opinion, is develop a fiscal program now that has some credibility in dealing with the budgetary pressures as the economy recovers, and some reasonable outlook that within a reasonable number of years we can restore balance in our federal budget, and that the federal debt will not continue to rise as a part of the GDP. What's that mean? It means a lot of effort on spending restraint. I think maybe some of the efforts, some of the talk in the political scene about the possibilities of cutting expenditures in practice may be exaggerated, but there's no doubt that we need restraint on spending. But it seems to me entirely likely that however much restraint we have on spending, we're going to have to rethink our tax system, which has had all kinds of weaknesses even in normal circumstances. We have a corporate income tax that stands out now as about the highest in the world, and unsustainable, I think, in our long-run fiscal and competitive position. That needs to be repaired, but it's not just the corporate income tax. Do we need to think about a tax system that is more favorable to investment and less favorable to consumption and less favorable to housing than has been the tradition in the United States? And that will be a big change. But while we're doing those changes, I think there have to be complementary changes in the rest of the world. You kind of forget the inexorable arithmetic. If U.S. deficits are going down, particularly external deficits, somebody's surpluses have to go down. We have to have some balance in the international system. And the efforts to achieve that balance or rebalance have been well known in terms of the need, but also well known for the lack of action in order to achieve that better balance internationally. I'm sure that is going to be the prime area of discussion here in this city next week when the G20 gets together. I'm sure they will make statements about the need for achieving this rebalancing. The United States has proposed a particular way of looking at it. When people's deficits or surpluses get too big, shouldn't there be an international consensus of complementary action to assure that current account imbalances, whether too big or too small, are moved toward an equilibrium? The challenge will be to move beyond the intellectual understanding, to move beyond the talk. What did one of the introducers say? That There's a difference between speaking for public relations and speaking with candor. And I think next year we will see that distinction challenged as the leaders get together, and will they be able to not only speak with candor, but go away from these meetings with some greater consensus of how to achieve that balance over a period of time that we need. And I don't put all the emphasis on exchange rates, although that may be necessary part of the solution. But the more action is taken in other ways in the United States to increase our savings and to increase our investment, and in other countries to increase their consumption, provide better social safeguards and support for their own citizens, in the long run, that is where we have to go on both sides. The degree to which exchange rates have to change, we'll find out in the marketplace, but we shouldn't resist them where they are necessary. So I come here more to engage in discussion than speech making, and I understand I may get maybe one or two questions out there, Mr. Chairman, if I understand correctly. So I will stop, but my message is, I don't know how it translates into Korean, but you all speak English, but the word that I described for the American economy is a slog. What comes to my mind when the word slog is used, you think of somebody trudging through a swamp or trudging through tundra, and you make progress, but you make progress slowly, and it's very tiring and kind of dispiriting. But nonetheless, you have to move through the swamp to get to the firm ground, and it's going to take a while to get there. But that's where we want to go. And I think with the strengths that we have in the United States for innovation and energy and education and entrepreneurship that we've had through the years, we'll see that rising again, but not tomorrow. Not tomorrow in terms of economic activity. We just have to have the patience, the fortitude, the discipline to see our way through this period and avoid running into the trap in the midst of potential impatience that we do things that are counterproductive. And let me say the one thing that would surely be counterproductive is to feel we can improve this situation, to speed up the economy, return to prosperity by having inflation. I think we've learned that lesson in the past. It should be drilled into and I think it is, into our central banking mentality. I think the population basically understands that, and we'd better not forget it, or all the constructive work that remains to be done will be jeopardized. So let me just stop there, if I may, Mr. Chairman, and welcome your questions, discussion, and see what else we can do here.
Solutions to the monetary issues and exchange rate issues, particularly in this very integrated world. I suppose that point should be even more emphasized. So we would like to bring this into this G20's context to find reasonably the cooperated and coordinated solution.
You say they're going to meet here and have an international assessment process. That sounds good, but it's difficult sometimes to get a common assessment. Well, what's really difficult is moving from an international assessment process to an international doing process.
That's right, yeah.
And,
Fortunately, this time, we already got the policy templates from 20 countries, policy templates of next 3 to 5 years, and IMF did worked on this, and IMF came up with policy recommendation at Toronto. Now G20 got the ownership, and then we are going through this. But the thing is, that's why Mr. Bernanke mentioned it in Gyeongju this time. But I would like to see, rather than taking all the individual countries reacting unilaterally, should be brought into the. But that leads me to it's a related question. You know, I often quote what you said. I don't know whether you remember it or not, but I think it was after Asian financial crisis. You said, you know, in the ocean of in the sea of capital, big liners like a USA may not be affected by the small ripples, but the South Pacific canoes can be greatly affected. Yes. So you did advocate do something about this, the capital market volatility. So do you still see this, the necessity of having some the mechanism by which this capital volatility can be reduced?
I do think this crisis, it's culminated a long period of disequilibrium. As being contrasted with the view that existed, you can leave the markets alone and they'll stabilize themselves. That view is kind of gone. And I think that's a good thing. The difficult thing is, okay, if we need some more intervention in markets, if we need a more orderly international monetary system, if we need a system that's less prone to crisis and less prone to big fluctuations, good, that's like assessment. Now how do we get there? Which is a really difficult question that becomes more difficult. They mentioned the ocean liner in a turbulent sea is better off than the canoe in a turbulent sea. But when I was more active, and you go back some decades, the biggest ocean liner was the United States, without any question. And you could get a little convoy of ships around the big one. Now there are a number of big ones. And that makes cooperation and agreement more difficult, I believe.
Yep.
And that's why we now have a G20 instead of a G5, instead of a G7. Everybody says you have to have more people involved, which is certainly correct. On the other hand, what are the chances of getting good agreement when you have, it was easier when you had 5 countries than when you have 20 countries.
Yep. Yep.
And that is I think, a big challenge of world governance.
Yeah, it is a daunting challenge for G20. But so far, G20 has been delivering, in my view, in dealing with current crisis. But the question is whether it will continue to do so in the post-crisis period. So we're working hard. I mean, Korean government is working hard to show the world that G20 still works, even after the crisis.
Let me go back to the easiest part of this that we haven't discussed it. That we have a breakdown in the financial system. We have a general feeling that we need reform in the financial system in a number of directions. There's also a lot of resistance to reform. And at the end of the day, after this great financial crisis, are we going to end up with reasonably consistent regulations and supervision around the world? Or are we going to end up with a lot of differences? And the more, if we end up with big differences, big gaps, that will, in my opinion, weaken the system and make it impossible for some countries to maintain a high degree of discipline while others are not. So this is a nice concrete challenge. We see it played out in Basel in getting common capital standards. Everybody says we need higher capital standards for banks. We need better liquidity standards. It was the first after the crisis, everybody said that. I mean, how can you not say it when you're in the midst of the crisis? But look at how long it's taken to try to get uniformity at Basel, and they put off many of the more difficult decisions for years.
Right.
So I think they're making some progress, but it's been very difficult on what should be the easiest of all the international regulations.
Yeah.
What are we going to do about this whole core issue of too big to fail?
Yeah.
Which preoccupies people in the United States or preoccupies people in Europe. Very difficult issue. Are we going to continue a system where big financial institutions get in trouble and the creditors will be rescued? In some cases, the equity holders, the stockholders have been rescued. Managements have been rescued. And everybody wants to get away from that. But can we do it? International institutions, you have to do it with some degree of consistency among the major countries.
Mm-hmm.
And it's not easy. I think we are making progress there, but it's you make a little progress and you go backwards. And I don't know how you feel about this in Korea, but in the United States and in Europe, but particularly in the United States, the financial markets have become enormously developed and overdeveloped. A huge amount of resources have been put into financial markets. The pay is out of sight in terms of what anybody thought was reasonable a few decades ago. There are billions of dollars being made. At one point, profits in financial markets in the United States were 40% of all profits. And those profits are measured, of course, after all the bonuses and all the other payments to the employees. But it just on the face of it, that industry, accounting for 40% of all the profits in the country, suggests something's the matter. And in fact, something was the matter. It all collapsed. And brought down the real economy in the process. Now we're going to rebuild that in a way that the financial markets do their duty, so to speak, of allocating capital efficiently. Or we're going to have what really amounts to a casino. There's two great instruments, two recent inventions in capital markets. One, credit default swaps. Did not exist 15 years ago. They were invented, I think, less than 15 years ago for a very limited purpose, or seemingly limited purpose, to provide protection to the credit of some basically corporate credits. So in 2007, there was $60 trillion of credit default swaps outstanding against maybe $10 trillion of credits. How can there be insurance policies 6 times the volume of what you're insuring against? It's just an indication that it has become a kind of casino and speculative vehicle. Then we had, I'm an old guy, I sit around, I don't borrow mortgages or anything else these days. In the old days, good old days, 20 years ago, on the mortgage in the United States, the typical mortgage was 20% down. And somebody from the bank went around to check up and see that the property existed and saw that you were not a crook and had a job and so forth. We forgot about all that, began making mortgages with practically nothing down, in some cases literally with nothing down, without any inspection of the borrower's allegations about his net worth or his job. And it created a nice bubble in the housing market for a while, rapidly rising prices, but it collapsed. And you've got to have some kind of understanding and I think agreement, not just nationally but internationally, on dealing with that kind of excess.
Mm-hmm. Yeah, you did mention in the early remark about the so-called Volcker rule to some extent, and that is related to Dodd-Frank bill. And you said that you're reasonably satisfied with this.
Yeah, well, let me Let me make a little plea about since I'm here, I've got a nice audience. My point was specifically that commercial banks should be prohibited from essentially proprietary speculative trading, either directly or in the form of hedge funds or equity funds. And the philosophy behind that is that commercial banks, in my view, perform an absolutely essential function in the economy. They run the payment system, they're the principal supplier of credit, certainly the principal suppliers of credit to small and medium-sized businesses, to consumers. They provide a backup for even big credits. The whole commercial paper market in the United States is, in the end, supported by commercial bank guarantees. And countries have always protected commercial banks, at least for decades, really for centuries. They have access to the Federal Reserve when they got a liquidity problem, deposit insurance, in a crisis. The deposit insurance almost automatically is increased, and they're heavily regulated. That's fine because they're important, and I think that ought to continue and will continue. But we shouldn't induce or permit those institutions to engage in essentially speculative activity which does not involve a customer relationship. And commercial banks are built around serving the needs of customers, and the customers are businesses and individuals. Speculative trading doesn't serve any customer's need directly, it serves the need of those speculating who want to make some money. And that's an entirely different cultural and attitudinal affair than traditional commercial banking. And if you mix the two, you got a problem. And I would say let this more speculative activity proceed, but not under the protection of the government. Taxpayer money should not be put behind institutions that are engaged essentially in speculation. So let's draw the line. Now, in the United States, it's only a handful of commercial banks, very large commercial banks, that engage in this kind of stuff. In Japan, I don't think banks, just culturally, do not engage in this kind of stuff. Most banks are not affected by this rule to prohibit it, but some banks are. Some big banks in Europe. I don't know about Korean banks. I didn't do my homework, but I would hope that in Korea, as in other countries, the big commercial banks or the small commercial banks do banking, but the speculative activities are limited because I think that's a different business. Traditionally, I don't think they've enforced this, but I didn't realize this myself until recently. The SEC, regulator of investment banks in the United States, their rules have made a distinction for years. I don't think they enforced it, and that's another question. They said if you have a customer relationship, if you're an underwriter or trading for your customers, you have a responsibility for that customer of a fiduciary nature. You shouldn't have a conflict. The customer should be fully aware of the nature of the transaction. If you're just trading in the market, you don't have a customer, you have something called a counterparty. And they say, well, a counterparty, you're just trading anonymously in the market, you have no fiduciary responsibility. And I think that's a distinction I'm trying to make in banking generally.
Well, since we have so many the experts and the leaders from financial community here, I'm sure there are many questions.
I want how do we say it in Korean? The Volcker rule or something. I want the Korean. How do you make my name in Korean?
Volcker rule? Yeah. Well, President Obama said that. That's why I said so, yes. Well, so everybody is interested, and that's why, you gathered here to share your views, because everybody wanted to see Chairman Volcker and how we see the world today. But anyways, I'm sure there are many questions and comments to be made from the floor, so I don't think I'll take up much more time. But Chairman Volcker is often quoted by the press that he believes that the greatest innovation and invention introduced in the financial community is the introduction of ATM machine, and not so.
It does bother me a bit, but I've offered a little hypothetical, maybe, reward to the first PhD dissertation that can demonstrate to me that all this enormous growth of financial markets and all the tremendous rewards of people in financial markets have had a visibly favorable effect on productivity of the economy, the growth of the economy, because in the face of it, I don't see that. Productivity was no greater in the last 10 years than it was earlier. And growth in the economy was no greater than it's been.
Yeah, so I think that quote is exaggerated, but I think what it says is that it's just unlimited, so-called financial engineering has its own problem. I think that's the point. Well, I think we can go on like this all morning, but I have to stop here and entertain questions and comments from the floor. Okay. Now, Dr. Joe. Yes, please.
Okay. Thank you, Chairman Volcker and Chairman.
I will see you this afternoon.
Chairman Sagong. Now I'd like to introduce Ambassador Yoon Jae-cho, Professor of Sogang University, to lead the Q&A session.
Take your questions, okay?
Right. Yeah.
Good morning, ladies and gentlemen. I'm Yoon Jae-cho of Sogang University and also Senior Advisor of Institute for International Economics. It's a great pleasure to be the moderator of this Q&A session. The time budget we are allowed for Q&As is about 25 minutes or 30 minutes. And I would like to economize the use of this time so that Mr. Volcker could entertain as many questions as he could, given the time constraint. We have already announced to submit questions in written form, and I have collected actually more than 30 questions from the floor. I don't think we can address all these questions to Mr. Volcker, given the time constraint. And if you allow me, I would like to take the liberty of grouping these questions into several big important issues. Perhaps I can categorize these questions into the Volcker rule and regulatory reform and its prospect for, as a result of a recent midterm election. And also second, you have already mentioned that, but there are many questions about the QEs. And also, there are questions about your views on the monetary policy in Korea. Our governor is sitting there, and also emerging market economies monetary policy, and also China, and also finally the role of Korea in G20 and after. First, may I summarize the questions about regulatory reform? There are quite a few people raised these questions, including Mr. Kalb of CIO of Korea Investment Corporation, Professor Jaemin Lee of Yonsei University, and Mr. Tae Sung-kwak, CEO of SEI Asset Korea, and also Mr. Kim, the president of Korea Capital Market Research Institute. You mentioned that reform is proceeding in the United States, but that you'd do it differently. Please tell us what reforms are done right, and what would you do differently? And also, may I also say that what would be the impact of the U.S. midterm election on the prospect of a financial reform bill? And also, following the strong midterm election result, could there be voices for ending the Federal Reserve System or at least cutting back some powers? What dangers do this kind of a populist movement pose for the U.S. and the global economy? And finally, in relation with this folklore, in Korea, the stage of development of investment banking is in nascent stage. Would you still recommend for Korea to follow folklore and separate it? Mr. Volcker, I would say that you could be selective in answering these questions. Please.
Well, let me, if I understand some of the questions you're asking anyway, let me address them. We had an election. Obviously, there was, I guess, an anti-administration vote. I think that election reflected a lot of frustration, basically about you stopped the recession and the threat of a depression, but nobody's very happy with the sluggishness of the recovery and unemployment remaining close to 10% without any very clear prospect that it's going to go down rapidly, as I was trying to say is very likely earlier. Now, what's the effect going to be on financial regulation? I really don't think much. There is, one school of thought that harks back to the basic philosophy of some years ago that the less regulation, the better. And now that we're out of the crisis, don't regulate so much. I don't think that's a sustainable view, politically or otherwise, and it won't be the main line of the Republicans in the Congress. They may want to change some specifics, but I don't think they'll change the general thrust of the law that's been passed or the work that's going on in Basel and elsewhere to get international consistency. I hope there continues to be some strong recognition of the importance of international consistency. There's kind of an odd debate at the time the law was passed about a particular provision, a very important provision in the law, which the proponents, the administration in particular, and certainly the Democratic majority, said this provision will deal effectively with the too big to fail problem. And just to explain a little bit, what they did was enact something called the Resolution Authority, which would provide authority to the government to take over a big failing institution, meet immediate obligations that it has from day to day initially so that the market isn't totally disruptive, but with the demand in the legislation that once the government takes over the institution, that institution must be liquidated. And the stockholders will lose, the management will lose, creditors will be placed at risk. And the legislation says there's no alternative. Now, there's a lot of skepticism about whether that works, and somehow the opposition took a view I don't believe is tenable, but psychologically they took it, and they said, well, by addressing this problem in law and providing any opportunity to deal with even tomorrow's obligations of that institution, you're philosophically or otherwise saying there can be government intervention to save the institution. I think it's either a misreading of the legislation or a willful lack of confidence in the ability to administer the legislation. And I understand the latter, But it's not going to be helped by not having the legislation, because then it's clear we didn't have the legislation before and we went ahead and rescued these institutions. And the whole purpose of this legislation is to reduce that possibility. And it's not only true in the United States, but there is a kind of intellectual consensus, I think, that something like this ought to be done in Europe anyway. I don't know what the situation would be here or in Japan, but there is a pretty good consensus, whether or not it's yet been put into law, to adopt a procedure such as is now in the American law. And it's important because these really big institutions are international. And you have to have some consistent treatment when they fail, whether it's a European institution operating in the United States or an American institution operating in Europe or Korea or Japan or wherever. This is one area where you really need consistency. And I don't think that will change, even though it's been the principal area of controversy in the legislation. So basically, you know, there may be changes in some details, there should be changes in some details that are kind of explanatory, but not change. And the basic thrust of the legislation I do not think will be changed. There's a question, I guess, about the Federal Reserve. One of the peculiarities of this whole thing, in a way, is the Federal Reserve has been heavily criticized, both because of its monetary policy, rightly or wrongly, being blamed for keeping interest rates too low, too long, and contributing to the housing bubble. And at the same time, their regulatory authority was not used to deal with the bubble or other weaknesses in the financial system. So the Federal Reserve had a lot of criticism, and there were people in the Congress in particular, people in the public, that said the authority of the Federal Reserve ought to be cut way back. And one version, we ought to have an independent regulatory agency, as in, I guess, in Korea, where one agency does all the supervision. But after the Federal Reserve took extraordinary action to kind of save the system in 2008, and that got a lot of criticism, but on the other hand, I think there was a recognition that it was necessary to save the system. The Federal Reserve came out of this legislative process with more authority rather than less. And in one way, I think that's appropriate, because I've always thought that the Federal Reserve, as a central bank, was in a better position to conduct banking regulation than other agencies, that having both responsibilities complemented each other. The regulatory authority could complement monetary policy and vice versa. And that was particularly true, should have been true before the crisis, it's true after the crisis. So that's what's been pretty much left with the Federal Reserve, the strongest regulator. But that does have some dangers over the long run. The more authority a central bank has, the more subject they will be to political pressures. So we'll see how that works out. But right now, the Federal Reserve is in a stronger position legally than they were before. It doesn't mean they won't be controversial, but they have dodged the bullet, so to speak, that some people would have aimed at it. And I hope they can effectively discharge that responsibility. Now, they're not alone. Other agencies also have regulatory authority, so we have a very mixed up system, but the Federal Reserve is clearly the strongest.
Thank you, Mr. Volcker. The next question is about quantitative easing and its impact. There are quite a few people raised this question, including Mr. Wissenbach, acting head of delegation of European Union, Alan Timberlake, head Seoul Global Center, and Mr. Chung of SC Bank, and also Mr. Choi Jin-ju of Hanguk Daily Newspaper, and Mr. Young-Se Lee, president of Daegu Cyber Universities. I found this question is quite provocative as a question of a diplomat, but let me read it for him. This is a question from Mr. Wissenbach, acting head of delegation of the European Union. How does the Fed's QE policy contribute to rebalancing the global economy? Doesn't it do the opposite by driving the dollar down, stifling growth elsewhere, and risk of bubbles in emerging markets? Is a weak dollar really the way to show international leadership for the global economy? And are targets for deficit and surpluses of current accounts suitable instruments for G20 to rebalance the global economy? And do you agree that infinite expansion of Fed's balance sheet is okay? I think this was already answered. And also there are similar questions regarding that. So there is the question.
I'm going to have to apologize. My hearing is not what it once was.
Oh, sorry.
You got so many questions somehow.
I'm sorry, may I repeat the question?
Yeah,
Mr.
simply.
Volcker? Okay.
What's the question about the dollar? Is that?
Yeah, the impact of quantitative easing on global imbalance, on the rebalancing of the global economy, and also are targets for deficit or surpluses of the current account suitable instruments for the G20 to address the global economy rebalancing problem. Rebalancing problem.
I'm stuck. I'm going to get up and stand right next to you so I can hear this.
Or maybe Mr. Wissenbach is he here?
Yeah, no, the microphone is fine. It's my hearing, and it's
okay, maybe.
I agree, huh?
Right.
Well, this is a pretty direct question. Okay. Well, I guess I get the point of this
after
question.
that, I will also convey you the question.
These are basically questions about what is the Federal Reserve doing with all this quantitative easing? Will that contribute to rebalancing the global economy? Or doesn't it do the opposite by driving the dollar down? Well, first of all, obviously, the action of the Federal Reserve is, in the first instance, directed toward the American economy, which is their responsibility. They're facing the slow growth that we mentioned. They want to see whether they can get interest rates a little lower in order to encourage the growth of the American economy, which I might say is not the one important from the standpoint of the world economy. I don't think anybody wants to see the United States economy relapse into another recession. So I would think, to the extent this action is important and necessary for some support of the American economy, I think it is very much in the interest of the world economy. As I indicated, I don't think it's going to have a dramatic effect on the American economy. They're looking around what they can do to deal with the sluggish economy. This is kind of the limit of what they can do, and it shouldn't make all that dramatic a difference. I understand there's a lot of liquidity in the world, and particularly goes to the economies that are doing better. So in terms of rebalancing the world economy, the responsibilities are not all on one country. It's necessarily a complementary process. And if a certain large country is worried about excessive liquidity in that country, and it's worried about the possibility of bubbles in that country, it has some responsibility to look toward their own actions. And to what extent are their own actions contributing to unstable and potentially fragile developments in their own economy. And so far as exchange rates are concerned, I don't want to predict them, and I don't think exchange rates are the whole problem, but any country who fears that it's getting expansionary process at home, it's too expansionary, it's inflationary, its own economy is getting unbalanced, might want to consider whether appreciation of the exchange rate was desirable or not. It's obviously a relevant consideration. I'm sure it's being debated in China. But it's nothing, you can't sit there and say, I'm going to do nothing, and all the responsibility lies with somebody else. That's not the way the world is. The response is you've got to get complementary action by different countries. And as I emphasized earlier, in my view, the primary responsibility of the Federal Reserve is to make sure the dollar is stable at home. And I do not see any strong case around the world generally for a weak dollar. Is the dollar overvalued against the euro? The euro's got its own problems. The Japanese currency, it's got its problems too in the other direction. This is not a one-way street, but the clear responsibility, and they better not forget it, is to maintain the stability of the dollar, first of all, in the United States. And I don't think this action is inconsistent with that. It would be inconsistent if they kept it up year after year, as one of these questions implies, in an infinite way, and never pulled back. That obviously would be totally irresponsible, in my view. But then you're worried about what could happen 2, 3, 4 years ahead. And I assume they are strong enough, intelligent enough, that they will not permit just infinite increases in dollar liquidity when it doesn't fit economic circumstances. Has the Federal Reserve invented a perpetual motion machine? Surely it has not. I like these questions. You got any more of these? The risk of bubbles in emerging markets. I think there's some risk of bubbles in emerging markets. And we ought to worry about it, but the emerging markets ought to worry about it even more. And not feel that they can live indefinitely on huge export surpluses. Let me take up the second question here a bit. Let's read it. Are targets for deficits and surpluses of current accounts suitable instruments for G20 to rebalance the global economy? I have had nothing to do with this stuff in the Treasury where they have proposed this focus on external balances, but I think it is a useful effort to try to get international attention to the fact that this is a multilateral problem. It's not a problem for any one country. It's not just a problem for the United States and China. China sits here and worries, and maybe over-worries. They say, well, we can't move because we don't know what the rest of Asia is going to do. And if the rest of Asia doesn't move with us, we're going to be put in a bad competitive position, and we're going to have difficulty employing people and maintaining the vigor of our trade. So they, in a sense, we say China ought to do something. China says, well, the rest of Asia ought to do something too. And all of that is true, but the basic point is you all got to get together and decide what to do in different directions simultaneously, because it's not a simple bilateral problem. It's not a simple exchange rate problem. Why do we overconsume? Well, the exchange rate was cheap vis-a-vis the RMB. Maybe that contributed, but that was a small factor. That was a matter of internal policy. Why is Chinese consumption so low? What's going on in the Chinese society and the Chinese economy that makes it so dependent upon exports when that's clearly unsustainable. The rest of the world cannot absorb all those exports without creating imbalance problems. So it's just, China cannot live on a huge export surplus indefinitely, just as we can't live with a big external deficit. So you've got to get together. Neither side can solve the problem alone. And those two countries can't solve the problem alone. Because Korea is going to have to get involved, and Vietnam's going to have to get involved, a little Vietnam. And so it goes.
Thank you, Mr. Volcker. Professor Incheol Kim of Sungkyunkwan University also sent me a similar question, and I think it has been taken care of. The next question is a related question. This is written in Korean, so I have to read. I have to translate it for you.
It's in Korean, huh?
Yes, sorry. Now, the Bank of Korea is facing a dilemma between exchange rate stability and price stability, which should be more emphasized in BOK's monetary policy. The former requires maintaining low interest rate, and the latter requires hiking the interest rate. Now, with this quantitative easing of the United States, emerging market economies may face a similar dilemma. What would be your recommendation?
This is a question in Korean about Korean policy.
Korea and also...
I think you ought to direct it to the governor of the Korean Central Bank.
Also about the emerging market economies in general.
I agree with everything he says. You asked the question. I don't know what I get. I'm not going to comment, obviously, on Korean policy in detail, which I don't know about, but all I can do is, it's very simple for me to say, and it's very difficult to do. It's an old problem. We'll never solve it completely. But somehow you've got to get some understanding that there is a common problem which won't be resolved by any one country, because everybody, in a globalized economy, everybody's dependent upon everybody else. And if we forget that, nothing's going to work very well, including the United States. We should not, we do have to worry about the value of the dollar. And sometimes we hear these comments that say the solution to the American economy is a little more inflation. I don't understand that when you stuff that says we need a little more inflation to deal with the American economy. You want to ruin the American economy, let's get a little more inflation. It might be. But that shouldn't happen.
Thank you, Mr. Volcker. May I also convey two more questions? And may I ask you to allow some more time? Now it's, it may take another 5.
Are these written in English?
Yes, it is written in English. Now, this question is about China, and may I read it for you? China is yet a rising economy.
Of so-called currency war, and that countries need to get together and avoid.
In the interest of world adjustment, change more lessons are.
그리고 그 환율에 대해서 많은 국가들이 불만을 표시하고 있고 저도 그런 불만을 충분히 이해하고는 있습니다. 하지만 그리고 또
중국 관점에서 다른 규모의 자본 수출만으로
자원 유출을 막으려고 하는 것은 그래서 흑자를 원하는 것은 저도 국제 결제 통화인 달러를 가장 많이 선호하고 이것을 추종을 하려고 하고 있는데, 그런데 이러한 행동이 각국마다 극단에 치닫게 되면